could pay cash for this house. What do you mean I'm not approved? If that line stings a little, you're not alone. In more than a decade of lending, that's the number one toughest question that I have a hard time answering. It pits common sense lending against red tape and regulation. Here's the reality. Post Great Financial Crisis, ability to repay or ATR rules now outrank the old school rules 5 C's of lending. ATR shines the brightest spotlight on capacity, documented recurring income, while borrowers who are swimming in capital get sidelined. And just a quick refresher, the 5 C's of lending are character, capacity, collateral, capital, and conditions. And that mismatch is exactly why asset-based programs exist today. And are these loans risky? Hardly. A 2025 KBRA study covering up 475,000 non-QM loans found that asset underwritten loans are the best performing alt-doc segment in the entire data set, stronger than bank statement loans and DSCR loans, and materially below the overall 3.8% default average. Conventional loans, just for comparison, showed a 2.7% default rate in Q1 of 2025. And personally, I think that's set to go up quite a bit in Q1 of 2026, but that's a whole nother story. The program I'm about to show you is hands down the most generous, maybe even bordering on reckless, asset-based program I've seen in 10 plus years. And when something this game-changing comes across my desk, I have to share it with you. I'm Andrew King, mortgage broker and recovering top producer at Wells Fargo and father of 2, soon to be 3, and of course your mortgage translator. Remember, this doesn't constitute a rate quote or an approval. This is just for educational purposes to get your wheels going. Traditional guidelines obsess over W-2 cash flow, but retirees, tech bros, maybe in between jobs, and liquidity-rich entrepreneurs may not show a lot of income. Asset-based loans flip the script. Show me the nest egg and I'll show you qualification power. All right, program number 1 is asset depletion, aka 84-month income. How it works: add up eligible seasoned assets, subtract the funds needed to close plus the required reserves, divide what's left by 84 months, and that's going to be your qualifying income. Key eligibility: minimum assets equal the lesser of $1 million or 150% of the loan balance. Max DTI is going to be 45%. Minimum 660 FICO, and no gifts and no non-occupying co-borrowers. And for cash out refinances, 500,000 cash out is going to be the limit unless you're doing a cash recoup on a home you just purchased, and then it's unlimited. Asset haircuts: we'll give you credit for 100% of cash accounts, checking, and savings. 80% for stocks, bonds, and mutual funds. 80% for retirement accounts if you're 59.5 or over, and 70% if you're younger than that. And there are some exceptions for self-directed retirement accounts where we can go up to 90% credit for the account balance. And why do borrowers like this option? It's great for folks who still have some verifiable income. They just need a little boost to qualify. All right, program number 2, asset utilization, frequently known as 60-month income. Here's how it works: add up liquid seasoned assets, divide by 60 months, and plug that directly into your DTI. Key eligibility: up to 80% LTV, loan amounts up to 4 million, and 620 FICO or above. DTI all the way up to 55%, 100% credit for cash and marketable securities, 70% credit for retirement funds, and only 3 months reserves required, and gift funds are allowed, making it hands down one of the most flexible asset programs on the market. And why do borrowers like this option? It's more aggressive math: 60 versus 84 months qualification, higher DTIs are allowed, and lower reserve hurdles. Perfect when you're all asset and almost no paper income. All right, let's go over some common misconceptions. Can I use business funds? Yes, but only if you own 50% or more of the business, and a cash flow test shows that this isn't going to hurt your business. Crypto counts, right? If it's converted to USD and seasoned for 60 days, then maybe. Otherwise, it's a no. However, the FHFA recently said, I saw this on Twitter, that they're going to be allowing crypto as assets for all mortgages. So that could be changing soon, but we'll see how long that change takes to hit the guidelines. Do I have to liquidate my assets? Nope, and that's a common misconception. You just want to see that they're there and they can paper trail them. So don't worry, your portfolio can stay invested. All right, let's do a pros and cons rapid fire here. Pros: qualify without W-2s or tax returns, competitive non-QM rates, far from hard money territory, lower historical default rates thanks to the oversized capital C. Cons: LTV caps, typically 80%. Asset depletion forbids gifts and non-occupant co-borrowers. And lastly, a slight bump in rate, probably 0.25% to 0.5% higher than full non-QM loans. Who should consider each option? Asset depletion, you've got sizable assets and some income, you just need a break on the ratios. Asset utilization, you're living off of dividends, you're between liquidity events, or maybe you just want some privacy around earnings. Action steps, make an asset inventory. Label each bucket 100%, 80%, 70%, or however much of it we can use. Number 2, run the 84 versus 60 month test. Number 3, book a strategy call with Ma. We'll put the link below, calendly.com/monarchlender. Bottom line, your money should work as hard as you do, even when it's sitting still. Asset depletion and asset utilization loans let you prove that power and unlock homes that are locked out by traditional financing. Smash like, hit subscribe, and I'll see you guys in the next strategy session.